Good morning, everyone. Thank you to FSMOne for inviting principal and in particular me for coming to this morning's presentation and being the first speaker among all the external speakers. Now, I'd like to start off with the fact that even though this year has been volatile, but generally, if you have managed your risks properly, if you have diversified your risk, you would generally be able to make some good money. And of course, like the nasi lemak, you have add a little bit more chili, then you may have, depending where you are, you can make quite a good return. All right? Now, let's take on. Why do I say nimble, risk-aware, beyond noises? Lots of noise. Recession? Don't know. Numbers in US look strong, right? Europe looks weak. And in Asia, China looks, what happened? All right? The rest of us are okay. So what it means is you just need to understand what are the noises, especially those from the media. So you must remember what you read on the newspaper. Sometimes they put up a headline just to catch your attention and for you to read. It may not necessarily mean it's the right thing to read. All right, that's the part of it. Now let's go straight to it. This is something we put together somewhere end of last year. And you'll notice that we have the word quality first before we talk about income or growth. Why quality? Well, the question is because after these huge rate increases from last year, the dialogue became, would there be a recession in US and Europe? And periods of very poor economic growth, only the strongest, best companies survive. And maybe even in that period, they get market share. All right? So you want to go for quality. So overall protect your portfolio. Then because of the volatility from the uncertainty, then you would say, I need a steady stream of income for you to provide stability to your overall investment. But you need growth. Last year, there's hardly any growth in your overall portfolio. Most of us will actually suffer anything from those who are conservative, from maybe negative 5% to as much as 20-30% down. All right? So this is where you need to grow to recover what you lost and make on top of that. I mean, that's the ultimate aim of investing, right? You want to make more money. So that's why we have equality, income growth. In macro-wise, US, whether you like it or not, the numbers look very, very strong. All right? The employment in particular data look very strong. But then on the other hand, the technology sector, which has actually rallied, they are the first one to cut staff. All right? Now the question is, would that continue to feed into the rest of the system? All right? Europe is definitely not going to go anywhere. All right, mostly down. China's PMI numbers, unfortunately, is a culmination of a few factors. The manufacturing sector is going through changes. All right? People are talking about having China +1, +2. If there's no growth in the manufacturing sector, then that means your PMI is not going to grow. But China at the same time has changed. Unlike previously, manufacturing used to be 40% of GDP back in year 2000. Now it's maybe about 30 last 2 years. While services is now about 40% compared to 30% back in year 2000. So the structure of the Chinese economy has changed. All right? And if that is the case, that means there is a totally different demand for your workers, different type of expertise. And China, to some extent, part of its manufacturing sector will no longer be what it was 30 years ago. But they are so cheap, so efficient, I can produce something for you at 2 US cents or something like that. All right? So that is not applicable. That needs restructuring. That is also something the Chinese government need to tackle, which Malaysia went through after the 98 crisis. For a long period, the manufacturing sector didn't go anywhere. Right? Only maybe the last 8-9 years, the E&E came back big time. So China will go through a similar type of restructuring, which is needed. All right? Then you talk about inflation. At this point, the US government, what they worry is that the core inflation looks very difficult. Don't come down, all right? And previously was wage rate very stiff. Then recently, people ask, hey, how come shelter? That means people you go and rent, shelter become very, very expensive. Now, ask all of you, most of you may have kids, cousins, nephews over in UK or Australia. They can tell you how much rental have gone up from last 3 years. From maybe first year is maybe in London is 250, then it's 320, now it's 420, next year talking about almost 500. And you ask yourself, why is rental going up so strongly? You must remember, last 15 years, the world has zero interest rates, especially in US and Europe. All right? And suddenly, yeah, the guy who borrow money to buy the property and rent the room to you is paying 1% interest to 5% interest. You think the gentleman will absorb the additional 4%? It's all yours. Plus the 3-4% inflation rate. Voila. So you have things like that. And suddenly Federal Reserve say, I still want to raise interest rates. That means your rental will go up one more leg. The only way to break that is your property sector collapse. Or your economy really take a crash. This is something the government may not be willing to endure. You don't want to have huge amount of NPLs. Now, you are going to what you call just a cyclical slowdown because of higher cost of doing business. Interest rate go down. Go up, right? So everybody slow down. Suddenly you create something snap, right? Wow, that's going to be painful. Then market will take on a totally different condition. But if those of you who are very being voucher, you say, hey, interest rate going to drop a lot, I can position myself, right? But in the between, then how do you manage if there is all this happen? All the volatility that will ensue from there? This is where I think you need to be, put on the thinking cap, the nasi lemak style. Later I'll show you our style of that, all right? So you can go on. So your central bank policy, we know is, China definitely needs to put in more support, whether it's cutting rates, targeted stimulus. I think the most important thing in China now is to restore confidence, really. Right? The rest is just dessert. All right? Then US dollar, will it peak? You reach a stage where people say, I don't want the US dollar anymore. I can't make money using dollar doing business. I need an alternative currency or alternative mode of exchange. All right? So you have a lot of things converging. And for me, this means volatility. But as long as you know that no government wants anything really bad to happen, then they need to come out and support. Then how do you, at the end of the day, position for yourself for the final, for that take? But in between, you have to be very, very, talk to IFAS, talk to everybody, talk to your bankers as to what they think, all right? Now, let's talk about this first. This is World Bank's estimates for growth. This year is definitely a bad year, so-called, all right? US, Europe, I think US will be near to zero, Europe will be negative. But what is they tell you that 2024, everything comes back. That means next year is a synchronized growth scenario between developed country and emerging countries. Now, you must think of yourself that growth do not come automatically. Like you are driving a car, you want a car to go faster, you must step on the accelerator. So your economy cannot go faster without something to tell them to go faster or stimulate the people to do more things to make it grow better, right? And most of it will have to come from some level of policy support, which I think interest rate cuts will be one of the main driver of that. All right? So this is just to highlight to you, one, you want to take a lot of risks, it may be 2024 second half because of the growth, synchronized growth coming back. But this year, definitely until somewhere the next 9 months or so, is not a time to take a lot of risks. But what is also evident is Asia and China will be the fastest growing region in the world. This is something undeniable. All right? Even with the so-called issues that China face, it will still be growing. All right? Just now, this chart has been shown. I'm not to say too much about that. This is the core inflation part. All right? Then you have the interest rate outlook. Now, this is a question when people say how low it will go at the end of the day once it all normalizes. We have to accept the fact that inflation in US going forward will no longer be sub 2%. For the last 15 years. That is not going to happen. Because that is when US economy is still having a lot of issues trying to recover from the global financial crisis. Post this, we are back to the normal world whereby there is no longer zero interest rates. There will be normal inflation. And if you believe at this moment, the market forecast that it will be anything from 3 to 3.5% as the bottom, then you go back to historical experience before 2008. Previously, interest rate, inflation, the gap is 50 to 65 basis points. Interest rate is always this high compared to inflation. What you call real interest rates. All right? So you think of the fact that, inflation, interest rate at this level, that means your inflation will be in the region of 2.5% to 3.5%. That means your interest rate will be anything from 3 to 4% or 3 to 4.5%. If you look at current level of 5.25, there's actually more than 100 basis points more of interest rate to go down to. Then you ask yourself, okay, will it be a fast cut or slow cut? Then you ask yourself how you want to put your portfolio together for that as well. All right. Next, when US peaks and all the stuff, US dollar will also peak eventually. All right, because people always go to US dollar in times of recession, times of fear. And last year was an added bonus. For the first time in 15 years, you park your money in US dollar, you get a return. Before that, it was zero. Right? So you say, okay, put only no problem. A US dollar cannot die one, right? Or something like that. Boom. That's why you have this very, very aggressive rate. And of course, all the forex dealers will be pushing it, to give you that, to give themselves the additional return. But usually when US dollar peaks, emerging markets do better. People move out of US dollar and go elsewhere. All right? And of course, China, false start, right? Open, very impressive, boom. But usually, in previous experiences, when they allow the tap to open a little bit better, loans growth is good, the market always follow. All right? And recently, in somewhere end of June, the current new BBOC governor actually said something about loan impulse will continue to be positive. That's telling you, that means their quota for loans is going to be expanded. So you think of yourself how you do that. And of course, on the other side, the foreign media will say, oh, the Chinese, all the hidden NPLs will become a problem again. So up to you all to think about that, all right? Because the hidden NPL problem has been around for last 30 years, right? So you think of it that way as well. So this is part of the awareness. Opportunities, we still like Asia. Macro-wise, inflation is less. We reopened from last year. Generally, we are still coming along. China reopened, strong numbers. I am not totally disappointed with China numbers, nor am I thinking why the Chinese government is not doing anything. No government will want to see themselves get into trouble because of bad policies. Somebody with more responsibility. Yeah? So, but generally, fundamentally, Asia is better. So I think we still like Asia. And one story I like to share with you is that despite last year, the whole of Asia looked so bad, there's actually two parts of Asia that actually, if you've been there, you make money. You have invested in India, or you have an ASEAN fund. So there's no absolutely, you cannot make money such a situation. And I think India and ASEAN continue to be quite all right. So as an overall package, Asia not only have the Northern Asian dragons, and part of ASEAN is coming back, and India seems to be the new favorite for some of the people. Japan seems to have some positive news. I don't know how are they going to shift that. But I think at this point, it's very much based on expectation, what's happening in Japan. All right, so you think of valuation for Japan as well. All right. Now, I'd like to talk about the income part. I already talked about that. This is when US 10-year Treasury yield peaks. When it peaks each time, bond prices rally for the next 24 months by 7% per annum. All right. So this is a cyclical thing. Because interest rates and bond prices is one for one negative one, right? So it peaks, so it's a cyclical thing, bond prices rally. So this is something, if you remember, last year, despite continuous interest rate hike, but December, when it was a 50 basis point hike, global bonds actually rallied, even until now. And then in January last year, it still went up 25 basis points, but the technology sector actually rallied right until now. Why? Now you must remember, both are the two asset class most sensitive to interest rate changes and GDP numbers. And both most sensitive, it actually can rally because of interest rate still going up. It's signaling to you there's going to be a pause coming soon in interest rates. So you take up you backdate it. December last year, January this year, last month they paused exactly 6 months. People always tell you market very efficient, look all you in front, right? 6 months ahead, right? So sometimes it's work. And suddenly now the dialogue change, maybe can still go up higher. I would actually wish the Federal Reserve raise interest rates once or twice more and take it over with. If they want to crack the economy, break the momentum and actually have a real recession, go ahead. If not, all this, partly it has to do with the fact that when inflation was high initially, they didn't raise rates aggressively. So they so-called lost face and credibility. So now, they hold it so tight. No choice. Must get this back. So this is very important. No, credibility is very, very important in any policy making. All right? It's very, very important. Nobody believe you, habis already. All right? Then you talk about the other factor that is going to drive bonds performance. This is something that is happening across of Asia, but this is actually derived from Malaysia. Budget deficit as a percentage of GDP. So before that, 30% was okay. Plunge was, of course, at that time, everybody give free money, right? The only few countries that never give free money is China and US. But they have actually their social system. So you have an improvement in the budget deficit situation. What it means is the budget deficit going forward for the next few years, not only in Malaysia, but across the Asia, and all those governments who are responsible enough wants to make sure that the budget deficit, even though it's going to increase, but it's by a smaller quantum going forward. If that is the case, that means the additional financing needed is less. Additional government bonds that need to be issued is less. That means less supply, better prices, right? And your rating agency will tell you, good job. So one, your government bond prices is going to look good. Your private credit should follow one. Bond is sometimes very, very obedient to our asset class. Interest rate go up, pop. Interest rate go down, go up. And then the government bond prices will always be the lead. Sovereign list. If the government looks good, the rest of the private economy should look good. So they follow also one. So structurally, you have this thing happening within the fixed income space to drive how bond performance may go and last beyond the next 24 months, right? Right until 25 or 26. That depends on how things go, right? So that's the other two. So there's two factors. You have a cyclical factor, you have a structural factor, all right? Why I'm starting this is part of overall diversification because you still have a lot of volatility. This is very important, okay? Next, you have got the China PMI. This one you show how it's made, but the June data came out. Manufacturing improved a little bit, but not a lot. It's still not above 50. Services continue to drop a little bit. Like I mentioned before, right? Manufacturing sector now is the smaller part of the economy compared to the year 2000. At the same time, the structure of the manufacturing sector currently is catering to the situation 10 years ago. Because the manufacturing sector cannot just change overnight. Suddenly, I transform a cement factory to an E&E factory. No, you can't do that. It's not like you go to a bank, I want to switch my 6 months FD to 12 months FD. Immediately can be done. That is a product, you must remember. Your FD is a product. But manufacturing, you cannot do these sort of things. Right? And at the same time, after 2018 trade war and the supply chain disruption, everybody will say that acknowledge the fact that I need to have a China plus one, China plus two supply chain elsewhere. Maybe India or the rest of ASEAN. And if that is the case, like Apple is a good example, right? They say in China my business continue, but my capacity remain. All new capacity growth is outside of ASEAN, but PMIs measures growth. And then at the same time, China's economy has changed. Manufacturing is no longer the largest. So certain sectors inside the manufacturing sector will not be growing at ASEAN, like cement production. So you have all this shrinkage feeding through the system. So that's why I allude to the experience of Malaysia back in the 90s, especially in the mid-90s onwards, right? So same thing. So this is where I would say that the Chinese government going forward have to talk about how to re-weaponize their manufacturing sector. Despite all these things, as long as you can produce something cheap, somebody will buy from you, or efficient enough, or good enough, right? But at the same time, services become more important. But services, you talk about different types of services, from financial services to etc., etc. Then you talk about different type of people, different type of industry, different set of policies to drive that and preserve the growth, right? Very, very important. So you talk about next 5 to 10 years, the Chinese government actually have no time to quarrel with the US. There are internal issues that they need to address. It's far more important than whatever the Western media say about them, right? That's the reality, right? Not to say I'm pro-China or anything like that, but domestically, they have a lot of things that's happened. A lot of it converge at the same time, all right? Things have changed. You have no choice. You have to do something. And you have to do it and it's a longer-term thing, right? Last time they start from zero when they reopen the economy. Everything is zero. Everything is so cheap. Grow only. But you are now no longer zero. You are like, their per capita GDP will be in like Malaysia 15 years ago. 10,000 US per capita, per head, right? So you are reaching a different stage. A bank branch manager in Beijing earns more than a bank branch manager now in KL. All right? Reality. All right? This is the other thing that's happening. Last 3 years, no businesses hire anyone, but every year there are 7 to 9 million fresh graduates or young people coming out, O-level, A-level, diploma, university graduates. 7 to 9 million people. So for the last 3 years, they generated something like 27 million, almost 27 million unemployed young people, as well as people who lose their job. This year will be another 7 to 9 million, next year another 7 to 9 million. You're talking about a population of Malaysia floating around looking for a job. And when you have people without a job, eating up savings, maybe their own, which they don't have, which most likely will be their parents, that will be an issue for the economy. Because spending is now, services is now a larger part, consumption, larger part of the economy. When that is not growing because of high unemployment, you have an issue. All right? You need, what that means? You need to create jobs, pay salary. Young men go like, tonight, you go somewhere, right? That is something to keep things going, okay? The other thing is this. This is an income distribution known across the world. The rich is always the lesser part, the poor is a larger part. But the other part China faces is they already have, before this, they still have pretty high poor people. 40% of population. That means 560 million people. But last 3 years, you would not be 560 million anymore. You would be easily 600 million people. That means half the population became poor. That is another impact on the economy. Because when you are focused on staple food only, and not going out to have a beer, your consumption cycle, your economic cycle ain't going to be very, very dynamic. So you have the current situation environment as well. All right? Then, is that really all bad news? Not exactly. The Chinese save a lot of money. This is something they save every year in trillions in renminbi. Last few years, nowhere to go, all lockdown, huge amount of savings generated. But how come they're not spending money? Well, a few things happen, right? Household consumption is only 39% of GDP, right? US is much bigger, Malaysia is also much bigger than that. Then you ask yourself, why do they not consume so much? Do they really save so much money? There's a few things. It's a structural thing. It's a two-layer to that. One is the fact that you must remember it's a centrally planned economy. The government is a large part of the economy. So in technical terms, they call it crowding out. People will tell you it's a crowding out effect. As you can see, in US, private spending is 70%, but they is 60%. But look at the number of government, the percentage of the government, 23%. US 7%. All right, corporate is no different. So what it means is the government suck up a lot of the money and not pass it to that. And you look at the fact, even India, which is so poor, their welfare system, the social benefit is far higher than China, what China pay out. You must remember, this is a transfer of wealth, from the government to the people. It's an income effect. And you do not see that, all right, in China. And this is also the other opportunity. Then you ask yourself, how is China going to improve on social benefits or retirement safety net? They may adopt what the US is doing. They have something called 401k retirement plan. Here is PRS. So private companies and all that stuff. Oh, I've got 6 minutes more. I better rush. Right? I took too long already. But this is a situation that the opportunity Chinese is talking about. All right? Then the other problem that you see is the outflow of money to buy the property in China is become higher and higher. That means people spend the money to buy property and they don't consume. This is another issue the Chinese government. That's why when given the lockdown, the situation the property sector faced, and statistics show you that 70-80% of a common household wealth is in the property they hold, and the secondary price market is bad, nobody will spend money, nobody will tell you the government don't know what they're doing. All right? I see my property value dropping on a monthly basis, blah, 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 confidence loss, high unemployment. All right? Quite similar somewhere. All right? So this is what I think is One, you need to control your housing costs. This doesn't mean that you take over the entire property sector. You need something equivalent to HDB, far larger scale in Singapore, HDB, all right? You need to boost labor income. That is definitely you must. That means you must upgrade your overall sector. This is the part which all of us here are trying to do. Raise return on household wealth. Welcome to FSMOne. Like, we are giving you opportunity to raise your income wealth. This is one, all right? Okay? And then increase government transfers. You think of all these things, all right? This is where you think of the policy direction that the Chinese government have to move forward. This is it. These are the things. These are the things. This is more qualitative than quantitative, but it has to be done in one way or another, all right? Of course, the other one, which is how the manufacturing sector, I think I give it the example of Alibaba, supposed to be broken into 6 different units, which means currently Alibaba got 6 different businesses within Alibaba itself. Some growing better, some not growing so fast, but all competing from just one source of resources to grow. So they need to break it up, provide opportunity for the better growing one to able to get money. The one not so good one, you survive, don't survive, I don't know. This is the reality of the manufacturing sector, which the Chinese sector have to face, which is no different than what Malaysia has went through in the late 90s until 7-8 years ago. All right? We talk about ASEAN. I say last year, ASEAN is the best growing performing country in the region in the world, together with India, partly the fact that we continue to attract lots of FDI. Going forward, more FDI will come in, more easily double the current amount going for the next 5-10 years. All right? Then you talk about the fact that in terms of correlation, we are much less volatile. That's why money automatically flow out to ASEAN last year. Because China was so volatile, right? They said, oh my God, I want to take part of my money, a lot of my money out of China, and I need to park it somewhere else. So it went up in India and ASEAN. So it continues. So in terms of the diversity of ASEAN is quite attractive. Think of it that way. Then next 24 months will be tourism coming back. At the peak, this is how much tourists spend in ASEAN. Now you're back to somewhere here only. So next 2-3 years, you still have talking about how to come back to this level. Ayo, sorry. All right. So this is the situation. All right. Okay. Conclusion. We still like US assets. We like Asia. We like ASEAN. All right. Here, I like to stress a little bit about China. A lot of people have all this lots of uncertainty towards China. I will put it this way. China is no longer the China 30 years ago or even 15 years ago. Things have changed. Even without the Americans or the developed countries creating all these political issues lately, their structure themselves have changed. All right? And once you reach a very high base, your growth automatically slow. Right? Because it's bigger and bigger growth, right? That automatically, people will ask the very simple question. Your growth has slowed from 20% to 11, 12%. Should I still pay you 20 times PE valuation, or should I pay a lower PE valuation? And on top of that, now you have all this so-called volatility from the political risk premium. So suddenly, previously, if you value China using a 7% discount rate, last year you may be using 12% discount rate. That's why the Hang Seng dropped from 30,000 to 15,000. But going forward, what is reality? The reality is the discount rate that you use will no longer be 7%. It will be nearer to 9 or 10 or something like that. Then that means the previous PE that you are willing to pay for China, which was 18 to 20 times, will now be a lower PE. There's a de-rating effect because you have a higher discount rate. So at this point, people are still grappling so what is the fair value for China, Hong Kong now? No, so much uncertainty. Economy is changing. So that's why you see Hong Kong, go up, come down, go up, come down, same thing. And you realize the A share market outperformed his share market. You compare it that way. Right? So this is a situation whereby market needs clarity. This is where the policies, I hope Yellen go there and say something generally okay, ladies charge, more gentle perhaps. We can get something moving. So this is where I believe doesn't make China uninvestable. It is still totally investable. There's still a lot of opportunity, but you need to frame the risks of China differently. The volatility that you face in China differently. The question to ask yourself is, China, can I break it down to A share, H share, equity, bond, in terms of diversification just within China itself? Nothing like that, yeah? All right? And if all the time you always have every dollar 30 cents go to China, you ask yourself now, should I actually reduce it to less than 30 cents to contain the volatility? Or I maintain at 30 cents, but the rest of my portfolio had to be more conservative to make sure that overall volatility from China is controlled. Think of it that way, right? So quickly through, give me 30 seconds to do some self-advertisement, right? This is what we have at this point, neutral on developed country, blah, blah, blah. We used to be positive on developed country because US, Europe went up, make money, we went to neutral. But then our underweight US, Europe went to Japan overweight, all right? The rest, we are still there. And why will we put this way? This is self-advertisement, all our funds. I can't put other competitors' funds to compare, but this has to do with the fact that conservative, mid-range growth. And this is conventional. So, why I say quality very important, you ask why? My global Titan funds, don't you know it, generally focus on the largest cap developed countries companies. Quality companies. LVMH, Microsoft, you name it, the best quality ones. All have zero borrowing, business model tak boleh mati punya type. Alright? Sure can go. Alright? LV cannot sell, MH sure can sell. No, that's a reality, right? Think of it that way, right? But what you notice is, bond is good. APDI is there. This is your sambal or chili buddy. It's shown, right? You've seen that. Last year was right down here. See, within 1 year, this is as of June. Suddenly it came back. Greater China is here. This is a reflection of the risks. All right? You stretch it out to 3 years. ASEAN is right up here. So this is an efficient frontier. Anything above the frontier, that means the fund manager did hell of a good job. All right? Then your global titans, this is the other one that some of you may be right. You notice that bond fund still there, global tax here. So you're talking about how you want to create your own best tasting nasi lemak for yourself. And then this is 3 years. That means you recapture all the volatility from last 2 years of COVID already. Okay? Then next is you stretch it to 5 years before COVID. Suddenly it tells you you should actually have more bonds. With 20%, this type of volatility compared to this. Of course, this one very exciting lah, all right? Everybody shocked. But then when it dropped last year, a lot of people not very happy, right? So you want to make sure that whether it's 5 years, that's a 10-year one, but that one is too far away, right? So you just say you give yourself a 5-year planning horizon thing. You think of all this. So how do you want to position all this stuff? Not only with my funds, of course, iFast got plenty of that for you, even all the things. But this is for my own self-advertisement. This is what I show you, and this is what you have. All right? Thank you, everyone. Thanks for your attention.